Here's a surprising fact: 80% of Indians don't have enough savings to cover a major emergency, whether it's a layoff or medical emergency or any unexpected expense. Now, here's the big question: if life throws you an unexpected curveball tomorrow, are you ready to handle the expense? Today, we are going to uncover why do you need an emergency fund, how much should you save for it, and where should you park this money. So, the feast is ready, it's time to serve. Let's start with the basics. Why is an emergency fund so important? Emergencies can strike at any time, and they usually check these four boxes. First, it's serious, something that needs attention right away. Next, it's always unexpected, you never see it coming, and often dangerous. It can derail your financial health. And finally, it needs immediate action. You don't have the luxury of time to plan. Here's a scenario: imagine someone earning well, paying their bills, and investing for the future. Then, out of nowhere, their company announces layoffs and they find themselves on the list. Or worse, they meet with an accident requiring immediate medical attention. What would they do? Now, think back to COVID-19 crisis. Millions of people lost their job unexpectedly, while others faced huge medical bills. Those who had an emergency fund managed to survive the storm much better than those who didn't. Hope I have convinced you with these examples of why an emergency fund is not a luxury but it's a necessity. Now let's figure out how much you actually need. It depends on your financial situation and the number of dependents relying on you. Here's a simple thumb rule. If it's a single income with no dependents, then save 6 months worth of expenses. If there are 1 or 2 dependents, then save 12 months of expenses. If there are 3 to 4 dependents, then save 18 months of expenses. But if it's a double income families, then reduce these numbers to 3, 6 and 9 months respectively. For example, if your monthly expense is 50,000 and you are the only breadwinner with 2 dependents, your emergency fund target should be 6 lakh. Now comes the tricky part. Where do you keep this money? But before that, an emergency fund should meet 3 criteria. It should be 100% safe because you don't want to risk losing this money. It should be easily accessible and be able to withdraw it within 24 hours. And finally, it should beat inflation, otherwise its value will decrease over time. Now, based on these criteria, 2 ideal options are liquid or money market funds. These funds invest in short-term debt instruments, usually maturing within 91 days, making them less risky. The average returns range between 4 to 6%, which is slightly higher than the regular savings account. However, it may take about 2 working days for the money to be credited to your bank account. For emergencies requiring instant cash, you can use the credit cards temporarily and pay back as soon as the funds are credited. Next option is fixed deposits. Let's start with FDs from large banks like SBI, HDFC and ICICI. These offer stable returns typically ranging between 5 to 7% and are a trusted options for many. However, the returns may not always beat inflation and premature withdrawal might involve penalties in some cases. But here's where things get better by small finance bank FDs. Small finance banks like Northeast, Suryodaya and Unity offer interest rate between 8 to 9.5%, making them an excellent choice for an emergency fund. Many small finance banks allow premature withdrawals without penalties, and the funds are credited to your bank account within few hours. Additionally, deposits up to 5 lakh are insured under the Deposit Insurance and Credit Guarantee Corporation, ensuring complete safety of your money. Finally, to wrap it up, emergencies can happen anytime and an emergency fund helps you manage them without derailing your finances. You should save 6 months worth of expenses if you are single with no dependents and more if you have more dependents. You can park it in liquid funds, money market funds for good returns and safety, or in small finance bank FDs for quick access, higher interest and immediate withdrawals with no penalties. Remember, don't use it for non-emergencies. Treat it as untouchable unless it's a real emergency, because our goal is to turn a crisis into a manageable situation and not a financial disaster. And that's all for this video. But wait, while having an emergency fund is crucial, there's something even more important that could completely change your financial future if overlooked. What's that? And that's the lead for my next video, so stay tuned. Until then, this is Savarish signing off.